Happy greetings, everyone. This is Ron Williams, dialing in from Switzerland, just doing the cyclical nature of markets. This has been one of the most important presentations in my mind, covering an area that I have focused on for many years. This is just going to be a basic overview. I want to share a few ideas, and if each of you feel that you'd be interested in a follow-up session, a part 2 or part 3, there are definitely further detailed advanced sessions I can give on cycles and the cyclical nature of markets. Now, before we start, just want to give a quick headline. I have new details, and I should explain on the next slide. Currently focusing on the market from an independent capacity, so independent market strategist, just beneath my name. And if you do now want to get a hold of me, please feel free to email me on my private email address, roniwilliams@gmail.com, roniwilliams@gmail.com. You can also catch me on Twitter, rwilliams77, LinkedIn, if you just type in my name, Ron Williams, and of course on forexstreet.net, the blog that is available on the FX Street website. So my details have changed somewhat, but please feel free to stay in touch as always. I'd love to hear back from you after the session and into the future, so we can chat markets. Now, just a quick disclaimer. I used to work at MIG Bank, and on the 6th of June moved on to a new horizon. I'm working out exactly where next to move to, but I'm using this wonderful metaphor picture illustration of a golden eagle flying in the sky as an example of what I'm experiencing at the moment, looking for the next goal out there in the market. But I'll be staying tuned here with FX Street with my independent market strategy. So please feel free to stay in touch. And in the meantime, just for disclaimer purposes, I no longer work for MIT Bank and am now currently working independently, and I'll keep you updated as to how things transpire. Now, for those of you that may be new to my methodology, it's important that I remind you or let you know what it is I've been focusing on all these years. I've been in the market for just over 13 years, and my key focus has been market timing. So that basically is the key objective for me. And that's broken down into 3 areas. Number 1, market cycles and geometry. So understanding how history can repeat itself into the future by looking at the rhythm of market movement, but also looking at correlations between different markets. Geometry is maybe the combination of price and time, and that's a whole other subject by itself. And then the last 2 areas really focus on short-term timing, and that is pattern setups such as Japanese candlestick trade setups and DeMark indicators and proprietary studies. So Japanese candlestick trade setups allow you to understand, the emotional health of the market, but also very short-term reversal signals. The majority of Japanese candlestick signals are reversal signals, keep that in mind. So it's very good for swing trading in volatile markets and for just gaining an edge in the market with more timing. DeMark indicators is a fantastic timing indicator developed by Tom DeMark, an investor and trader in the market for well over 40 years. And this is something I've used for some time since working with Tom DeMark in my previous employment at Bloomberg for several years. So these are the 3 areas I focus on: market cycles and geometry, Japanese candlestick trade setups, DeMark indicators and proprietary strategies, and the number 1 goal is market timing. Now, it's traditional for me to ask in each of my webinars, where in the world are you attending this webinar from? Each of these webinars, which I've been giving now every month for the last year and a half, are truly global webinars, these webinars in association with FX Street. And so my question here to each of you, as I to the forum, and if you could just let me know where in the world are you actually attending this from. So Gam is from the UK, which is still raining. Where is everyone else from? UK? Just got a few confirmations. Where in the world is everyone actually attending from? So which country are you actually in at the moment? Africa, Australia, Spain, and a few other countries. So we have a few attendees today, and from different countries in the world. So I'd like to ask the question, where in the world are you coming from, just so you can all know that this is a global attendance from different countries in the world, but also to make a point about capital flows that I like to make, in that different countries around the world have different investment and trading ideas. And so we look at the world, we look at the financial market in different perspectives, similar to a prism being seen from different angles. So I want you to just keep that in mind whenever attending these webinars. It's a two-way forum where I can learn from you just as much as you learn from me in understanding how you look at the market and how the opportunities may change from day to day. Okay. So we're going to begin with the end in mind, and as always, I would like to focus on the key areas that we'll be looking at today. 3 parts. Part 1 will be focusing on the basics, timing is everything, the history and importance of cycles, crowd psychology, the perfect cycle. Part 2, just a quick look at the classic methodology, know your market history, just a quick tip that I want to suggest to you. And then just how you can use moving averages just to do basic cycle overlays. Part 3, I just included 1 or 2 charts of interest on the US stock market, gold, and in follow-up presentations I'll include something on the US dollar and oil. But for now, what I did add to that is US GDP and just general economic cycles as well as financial market cycles. Okay, so I want to ask this question. Everyone can see this picture here of a cheetah racing across the jungle on the screen with the title above, Timing is Everything. And so I want to open this up to everyone as to how they feel when they see this photo, this picture of a cheetah racing across the jungle savannah. What does it make you feel, and what does it tell you about timing? I'm just going to quickly switch to the forum, and if you just know, what does this tell you about timing generally? So I'm just going to wait just a moment or two. So Carlos is saying fast. Anyone else? So the feeling of something moving fast. How important is timing to this cheetah? Precision. Thanks, Borgie. That's a very good description. And essentially, I mean, what is this? I mean, cheetahs are generally known as hunters in the jungle. And so why is timing so important to a cheetah? So Borgie is saying waiting, so timing and waiting, as well as position, so not just being the fastest animal in the world, but also being able to wait and anticipate certain movements of maybe its prey. So absolutely agree with you, Borgie. Any other contributions? Anyone else have any feelings as to how important timing is? Okay, so I'll keep that idea there floating in the forum. I thought you've made a good point that it's precision, waiting, so having the patience to pounce. And Carlos makes the point about being fast. Good point by Dorothy. Hey guys, don't be shy. Totally agree with you. We've got quite a few participants here, so feel free just to kind of share your thoughts. But for now, I don't want to keep things streamlined, so I'll just quickly move on to the next slide. But just keep in mind, timing is everything. And with this picture of the cheetah, how important is timing to the cheetah? Carlos says, you know, it's an experience of being fast, and Boji made a very good point, precision, but also the position to wait, be patient, and pounce before actually making a move. And this is very similar to the market. I just want to really highlight the point of why timing is so important in life, but also in the market. Now, in the market, timing is very important because mainly because of the volatility that we experience. And certainly I've been a big believer in the increased volatility that we've had since 2007, since the financial crisis. And it's been very reflective of this probability distribution, this statistical probability distribution that you can see here on the screen, which basically highlights the extreme risk that happens in the market on a more regular basis these days. So the yellow areas of this distribution highlight the long tail or the fat tail of this distribution and the risk. And just telling you that we have more risk events happening in the market, and that is driven by much, much larger historical volatility. This is something that we need to keep in mind, these black swan events. And certainly, timing is one of those things that will really give us an edge in the market. Keep in mind this is across all time frames, intraday, daily, weekly, and monthly. Timing is everything across all time frames, especially when the market is volatile. Now in life, we live with time. You can see here this wonderful, beautiful picture of a watch. I'm calling to you guys from the land of Switzerland, the land of watchmaking itself. And you can see here that in life, timing is very important. Knowing when to wake up, when to go to work, when to go back. But also in the trading timing, there's quite a lot to be learned there. So just keep that in mind in terms of that side of things. Now, timing was also very important historically to many ancient civilizations. So now we use timing, you know, as a wristwatch or a clock in the office. But keep in mind that the calendars, many thousands of years ago, were developed by ancient civilizations, the Mayan civilization being one of the most famous for their calendar. And they developed a calendar so sophisticated and so accurate that up until this day, it was only when we developed the atomic clock that the Mayan calendar was actually so precise, almost as precise as the atomic clock. That's something that was only developed very recently with a lot of our advanced technology. Now, back then, calendars and timing generally in life was developed according to certain movements in the universe, planetary cycles, so the movement of the sun, the moon, the earth, and various other relating planets. And this would allow to basically establish our modern day calendar. Of course, one key point here, I'll just keep in mind just for interesting conversation, of course, we are in 2012, and some of you may have in mind that 2012 prediction for late December of this year, which means two things. Some people popularize it as the end of the world scenario, but a few growing kind of observers in the market, including myself, are seeing it more as an important change out there to be anticipated. Now, in the financial market, time is very simple. You have a price axis and you have a time axis. And the movement in the market, so if the market were to push up in this territory very fast, or just move on an average basis along the straight line or beneath it, that is the price appreciation over time. And that's all it is. but it's a combination of the two which is very critical. Now, one of the points that I always make in market analysis is that we spend far too much time focusing on price analysis. So we'll look at various projections from patterns, from trend breakouts, from various other methodologies, but we'll spend very little time looking at the timing in the market. When is something going to happen? Now, the reasons why we have cycles in the market, there are many reasons, but one of the reasons I want to focus on the most is crowd psychology. And here we have a sine wave cycle, a cycle shaped as shaped as an S. And we can see here the various emotional stages from a bullish market to a bearish market. You can see we begin with optimism, enthusiasm, exhilaration, euphoria, and this is very much what marks the end of a bull market. Then we capitulate into more of a bear market mode when there's a little uncertainty, denial, pessimism, panic. People are really scared and frightened of what they don't know is going to happen. And then capitulation at the final end where really a lot of people have lost money and they are quite depressed from this. The despair is very much where the bear market then ends. And then we start all over again within the positive cycle on hope, belief, and optimism. Now, just going to quickly switch to the forum here. Does anyone have any questions? Does anyone have any questions of what I've covered so far on this? Any questions? Or shall I continue? Give me a yes if you would like me to continue, and ask any questions if you would like to ask any questions. Okay, so I'll continue then. So that's very much the crowd psychology, the perfect cycle that actually allows these cycles to take place in the market. Now, part two, what I want to focus on is just classic methodology that I've been teaching in some of my educational sessions as to how to incorporate cycle analysis within your traditional day-to-day analysis. I want to make a point about maybe using moving averages and a point about knowing your market history. Now, in classic analysis, I've always described the market analysis that we do every day across FX or any other related market as a pyramid. And just think of the pyramid, the top part of the pyramid being the most important part, and that is the trend or the cycle. And then we have beneath that key levels, and then last but not least, indicators. Most people in the market only focus or focus first on indicators just because it tends to be that much more attractive, and people are looking for the best performing system so that they can make money as fast as possible. But of course, we know that it takes a lot more energy and dedication to be able to have a successful strategy in the market, and of course, increase that performance in the market. One of the key things improving your performance in the market is by knowing the trend and the cycle of that market. And this has always been key to me. And think of it as a roadmap. First thing in the morning, you want to place your trade in the market, you need to know the roadmap. Just like you're sitting in a car and you're driving between point A and point B, you need to be able to know the route or to have a rough idea of the environment that you're driving in. And it's exactly the same thing within the financial market. Now, when we're looking at the trend and the cycle, we really must keep in mind that this concept of cycle being expressed in 3 different time frames. So there are 3 key cycles, never just one cycle, it's 3 cycles. And the best way that I can explain this is if you can think of the ocean, the sea, and how the ocean tends to have 3 different variables which drive that movement in the sea. You have the tidal movement, the big fat blue line on the screen. You have the waves, the light blue line on the screen. And then you have the ripples in the water, When you drop a stone in the water, you get this really subtle ripple effect. All these three things, the tide, the wave, and the ripple, work together in a natural way to produce movements in the sea. And it's exactly the same thing in the financial market. We have the big fat blue line, which is the long-term, multi-year cycle. We have the medium-term, multi-month trend or cycle, which is the light blue line. And then we have the red dotted line, which is the short-term, multi-day, multi-week cycle. Now, does anyone have any questions on top? Because this is quite important. So Boyd is asking which markets are the three key cycles referring to. This can be any financial market. So this can be FX, it can be stock markets, it can be commodities, and fixed income, any market. Now, obviously, cycles do change between market to market. A cycle is a way of understanding the rhythm of a market and understanding the personality of that market. And so different markets have different rhythms and different personalities. Does that help your question, Dorothy? So I would say I'm applying this theory across all markets, but also keep in mind that cycles measures the market's rhythm, the market's timing, or the personality, and that is very much different from market to market and time frame to time frame. Can anyone tell me what a cycle on a short-term basis is likely to be versus medium-term, long-term? What a short-term cycle is likely to be in terms of their personality? So how can anyone describe what a short-term cycle might, how a short-term cycle might behave? Anyone? I'll pose this question to Boyke because you're the most active today. How to describe a short-term, multi-day, multi-week cycle compared to a medium-term or long-term cycle? Yeah, jumpy or quite volatile. And you can see here, that's why when you look at the diagram here, the Mike saying more volatile, absolutely. You can see here the red dotted line is a lot more jumpy, it is more volatile, there are more ups and downs on the red dotted line, and that's very much how intraday short-term cycles trade in the market. Now, of course, medium-term and long-term, you can see the big fat blue line and the light blue line are more fluid. The light blue line, you can see you go market high, market low. It's a fairly consistent cycle. Now, the long-term big fat blue line, with this long-term cycle, is actually a lot harder to change, and that's very much kind of like a multi-year cycle, which takes a long time to take care. And think of it as basically a very big ship in the ocean that takes time to actually turn. Each time it turns, it'll take many months or many years to turn. So keep that in mind. Now, one point I want to make, and I'll come to your question, Mike, is this point of how you can trade each of these. Now, intraday traders here on FX Street, which cycle are you likely to trade the most? Anyone tell me? Mike or Boyke? As intraday traders, which cycle are you likely to trade the most? I'll let you come back with the answer. But most people focus on short-term intraday or multi-day. Mike's saying short-term has more opportunity, absolutely, so you can make more trades on the short-term time curve. But keep in mind that even if you're interested in the short-term time curve, it is very important to focus on the medium-term and the long-term. And one of the pictures I usually show is a picture of a tidal wave coming at you. If you're in the ocean and a tidal wave is coming at you, it might be miles away at the beginning, but eventually that tidal wave catches up with you. And this whole point about having three cycles is actually quite important for that very reason. You might be focusing on the intraday or the short-term cycle. But you really need to be aware of the medium-term and the long-term cycle, because that will influence your short-term focus eventually. And so that's why it's important to look at long-term and medium-term charts as well. And so when I say long-term, medium-term chart, please keep in mind long-term is multi-year, to look at the 1 to 10-year chart. When I'm talking about medium-term chart, I'm talking about multi-month, so several months up to a year. And then short-term can be intraday, so your 5-minute, 15-minute, 30, 60-minute charts for your entry confirmation level. But of course, you need to be looking at medium-term and long-term to confirm that big picture view. And of course, some of the moves that we've seen recently, for example, Eurodollar punching to a new 2012 low, gold when it was approaching the $2,000 mark early last year. These markets, in order to actually understand the short-term trading opportunities, as Mike said, short-term has more opportunity. It's important to keep in mind what type of opportunity it is by looking at the other cycles, the 3 cycles in the market. Now, Mike just asked a moment ago, where are we now on the curve in US equities? I'll come to that right at the end of the presentation. I still basically believe that we're still within a long-term bear market, or the long-term secular market. But of course, we're having a little bit of a positive bounce now. My key point, if you remember one thing from my presentation, is that the month of July is going to be a highly volatile month in the market. And this is due to classic cycle analysis that I look at, but also some proprietary cycle methods that I look at each day. Is that okay, Mike? Does that help answer your question on where are we now on the US equity side? Just wait for a quick yes from Mike. Okay, I shall move on now. So that's in terms of 3 cycles. Think of it as the sea, the big tide having an impact on the wave, which has an impact on the ripple. It's a domino effect. And this is exactly the same in the financial markets. We have long-term, multi-year, medium-term, multi-month, and short-term, multi-day, multi-week. Now, one way that you can actually measure market cycles is by looking at moving averages. I use moving averages occasionally, but I use other methods to actually measure cycles in the market. The way I recommend to you is to use moving averages to start with. So I would say the moving averages that are most popular for measuring long-term, medium-term, and short-term cycles is long-term, the 200-day moving average, which is seen as the yearly average. Medium-term, the 50-day or the 100-day moving average, depending on how sensitive you want that moving average to be. And short-term, the 20 or 25-day moving average. Keep in mind, 20, 25 is the average number of trading days within a month. So 20 to 25 is your monthly average. 50 to 100 is that medium-term benchmark within the year. And 200 days is the long-term average of the year. Any questions on that? On the moving average? I usually get a lot of questions on moving averages. Some people like to optimize moving averages and they pick different moving averages for different markets. I prefer to use moving averages which reflect the cycle in the market. So if I'm looking for the monthly cycle, the yearly cycle, and so on. Now, both you've just asked, if it's sell in May and go away, when is it likely to return and buy? Well, cycles can also be reflected as seasonal performance. And this is a good point that I think Dorothy's alluding to. Sell in May and go away has very much worked out this year. We have had downs and then ups during that time, which is normal. Nothing moves in a straight line. But generally speaking, early May, we did start to have a major sell-off in the market as all the high-risk appetite markets started to unwind from their strong, powerful uptrend that started in the fourth quarter of last year. So there's a little bit of profit taking, but also seasonal weakness when volatility starts to increase because the volumes are quite low during the spring and summer period. Now, to answer Dorothy's question, if it is still a mango away, when is the market likely to return for a buy? So the markets which have fallen down, the US stock market or the Western stock market, euro dollar, Aussie dollar, gold, and various other risk markets, my answer to that would be the end of the third quarter and the fourth quarter of this year. So Q3 and Q4 are roughly the buying opportunities that I'm looking for. And if I was to give you a month to start watching for potential buying opportunities, that month would be October. I think October is when we get a big selling climax, the very bearish movement into October. I would say July 1st, next month, high volatility and further downside on some of the risk markets. But also October, which is also seasonally a very volatile month. And that should build a potential recovery period, which will allow us to maybe think about a buying opportunity in the fourth quarter of this year. Does that help, Ozzy, answer your question? This has been a view of mine for some time, and in future webinars I'll actually be more specific as to where the turning points are in the market. Okay, so my key point here, just going back to the slide, is moving averages. So just keep in mind the long-term moving average would be a 200-day moving average, the medium-term cycle 50 days or 100 days, and the short-term would be 20 to 25 days. And of course, whenever you get these moving averages crossing over each other, intersecting each other, then it will tell you a change in cycle is taking place. So if the short-term moving average, the 20-25-day moving average, crosses above the 50-day moving average, above the 50-day moving average, that will tell you that short-term cycle is starting to outperform and momentum is starting to increase in the market. Now, one point that I made here was a picture of the ancient pyramids of Giza in Egypt is to know your history. We can get very technical about market movements by using the averages or by using various indicators to work out entry and exit points in the market. But what is most important and has given me an edge in the market is literally knowing the history of the market. So when you look at the chart of euro dollar, keep in mind when the extreme high was, when the extreme low has been. When you look at the Western equities market, the S&P 500, Dow Jones Index, how volatile has the Dow Jones been? When was the last time that we've seen a similar move to what we're seeing now? Some people say 1966, 1970 to 1982. Some people say the Great Depression. So it's important to keep these historical points in mind. If you're looking at intraday charts, let's say a 15-minute chart or 60-minute chart, also it's important to look at the historical context, because it provides that big picture, it provides that context of the environment that you're trading in. So know your history, and by knowing your history, you'll have a good understanding of the market structure, the cycle, and what that might mean for the turning points and the trading opportunities that we trade every minute, every day. Now, does anyone have any questions here? So, Audrey just said under 50s or else. Sorry, Audrey, could you clarify the question? Could you clarify that question that you just asked about under 50? Simple or exponential? Yeah, so the type of moving averages to use. I mean, I would say that the more responsive moving averages are better, especially if you're trading on an intraday basis. So for intraday traders, I would say choose the most sensitive moving averages. And so exponential moving average is probably the best, I would say. But for general daily, weekly charts, simple moving averages are okay. The changes in the averages won't be as important as if you were trading intraday. Now, if you are trading intraday, and I am trading intraday myself, I would recommend actually, just quickly go back, taking a note from this picture here, which is actually a picture of multiple moving averages. This is what we call a moving average band, a spectrum of the moving averages. So we're talking about 10, 20 moving averages, which are very close to each other, but this allowed you to see the subtle changes in momentum in this kind of domino effect of moving average movement. It's one of the methodologies I use, and you might be interested to use it, using several averages just to get a real accurate, sensitive leading indication of how price momentum changes over time. And this is particularly good for intraday trading. Does that help answer your question, Boyke? Yeah? Okay. So I would say exponential moving average for more sensitive trading, like intraday trading. And for intraday traders as well, I would recommend using the moving average band strategy, which basically is several moving averages all very close to each other. And whenever those moving averages compress and expand, that tells you something about changes of trend and cycle in the market. Okay, so we finished part 2, classic methodologies and moving averages, but also knowing your market history. Just a quick tip that I made about knowing your market history, to keep in mind charts like Eurodollar, which has made fresh new lows some time ago, gold last year when we approached the $2,000 mark. Part 3, key market cycles. I'm just going to quickly show you a chart of the US stock market. So Mike asked a question about the US stock market and where we are at the moment. And then a chart which I've shown many times on gold. US dollar and oil I'll keep for future webinars. I'll probably in the next webinar talk more about market trade setups which are about to be triggered in the month of July when volatility is likely to pick up. And I'll end on economic cycle using the US GDP growth indicator, just to highlight one or two interesting moves that we might have later on this year. Now, in the stock market, there's the long-term cycle that we tend to talk about is secular and cyclical. Secular basically means a generational cycle. So anything which tends to last for, let's say, 10, 16, 18, 20 years, let's say 16 to 18 years, which is roughly the time we take within the industry in terms of our analytical careers. Whatever we might do in the world, our career in the market spans a generation of 16 to 20 years. And so if you think about it, the market that the market cycle that we experience is a professional lifetime experience, generational experience. So the bull market of the 1980s won't be something that we remember that much. Our current generation are remembering the movement that we've seen in 2000. The cycle of between 1970s and 1980s, you can see that I'll show you with the mouse, the sideways volatile range here during the 70s and the 80s is very much something that a lot of the new generation of people will not remember. So this is the chart of the S&P 500. You can also look at the Dow Jones Index. And it just basically shows how these long-term cycles of 16 to 18 years alternate. You can see here, this is the most recent cycle that we're in, which began in 1999 or 2000, when we had the dot-com technology crash. And then, of course, we had the housing bubble, the credit crisis, and then so many other black swan events which triggered the volatility and the sideways movement we've had in the red box. But that was very much a correction of the 1982 to 1980 bull cycle, where we had kind of a growth of strong economies, outperforming stock markets, and so on. That also alternated a very volatile and politically unstable period of history during the 70s and the 80s, when we had a lot of sideways movements, but with very big drawdowns. This movement here, this correction here, was roughly 50% down in a very fast 50% move on the downside. So you can see just how uncertain those times were. And in terms on the political side, we had many wars, like for example the wars in the Middle East and in Asia, and we had the oil spike crisis during the 70s as well, which resulted to a lot of high inflation. That period was a correction or a recovery period during the 1950s and 60s, the next, the prior boom market, which was a boom following the crisis years of the 1920s and 30s, or 1930s and 40s, I should say, when we had the Great Depression and when we had the World War II. So it's interesting how you can see how these generational long-term cycles not only impact financial markets, but they also impact economic growth and social and political changes. The cycles alternate from bullish to bearish, and during each of these cycles, there are different types of trading methodologies that we can use in the market. Now, I just want to quickly go back to the forum and ask each of you, and I'll ask Boyke and Mike if you could make a suggestion, but also anyone else that would like to make a suggestion. What trading methodologies do you think work best during the bearish cycles and during the bullish cycles? So the bearish cycles that we're currently in, and the bullish cycles that we were in during the 1980s and 1990s. Any ideas? What trading strategies tend to work the best? So just give a moment or two on this question. During the bearish cycles, the market is very volatile. There's a lot of price swings in the market, a lot of turning points. So Mike saying bearish, so you could buy puts, you could use the options market as a hedge or as a way of getting kind of a sophisticated trade strategy. Carlos is saying trends. So during trending periods like the 1980s or the 1950s and the 60s, any trend strategy would be very useful. Moving averages and just various breakout strategies. During the bearish volatile period, you still get trends, but it's a lot more volatile. You get a lot more false signals in the market, and market timing tends to be key. Now, market timing is one thing, but the other point to keep in mind is managing your risk. During volatile markets, it's not just about making money, it's more about capital preservation. And so during volatile, sideways, bear markets, it's really important to preserve your capital and to really have a good exit stop loss strategy. That's one thing I always focus on, because a lot of people like to talk about, strategies that can increase your performance and allow you to make more money. It's equally, if not more important, to focus on capital preservation, because people lose more money during the bear cycle in history than they do naturally during the bull cycle. And so it's really important to adjust our psychology, because we are likely to get things wrong more than we get things right. And we are more likely to get false signals, whatever trade methodology we use. And so it's very important to know when that exit point is, what type of stop loss strategy we're using, and how can we improve that risk side of trade. Now, Gams just made a very good point here. Also, in terms of asset allocation, we might need to be a bit more defensive during various cycles. So if you're looking at medium-term, long-term, and you're deciding between different market asset groups, asset classes, you might want to focus on yields, bonds, or gold. Markets that tend to outperform the stock market. And if we look at charts which show the stock market versus commodities, or the stock market versus various other cross assets, we can see that clearly some of these other cross assets are outperforming the stock investment ideas, certainly as Gam mentioned, you would look for more defensive plays like yield, bonds, and gold. Now, Morpheus asked a good question. What is the opinion of buying holds versus trading? Well, this is a good point. I mean, during volatile bearish cycles in the market that you can see here on this chart of the US stock market, the S&P 500, going back to the 1900s, what you can see is that during the red areas, trading methodologies tend to work best. So market timing, really good, precise stop loss strategies work best, and more active trading, being in and out the market, making your money, but trying to lock in that profit very quickly because you might lose it very quickly. During the green areas, the long-term bullish market, this is when buy and hold strategies are very popular. You can just wait for the market to make a new high if you're buying, continue to buy. Wait for the moving averages to give you a buy signal or sell signal in the bear market, whichever way. But the trends are much more obvious. The trends are much more easier to identify and trade. And that's my opinion, both in terms of buy and hold versus trading. During the bearish cycles in the market on the stock market chart, but also across asset classes, buy and hold is much more difficult. Asset management firms or pension funds have a very difficult time to enforce their buy and hold traditional strategies during bearish cycles. Whereas, average day traders, especially yourself and Mike and me, maybe have a better time trading the market during volatile periods of time. It isn't easier, but there are more trading opportunities, as was mentioned just before. Does that help answer your question, Blakey, on buy and hold versus trading? So there's a few points to keep in mind. My simple answer is it depends on the cycle. And currently the bear cycle that we're in the stock market, but also across asset classes, there is an increase of historically high volatility. Trading is far more superior now to buy and hold, and even some of the long-term asset managers out there are starting to take more of an active portfolio management strategy, because it's very difficult just to focus on the traditional passive buy and hold methodology. Okay, that's the US stock market, but the US stock market showing long-term generational cycles from the 1900s, alternating bearish to bullish, bearish to bullish to bearish. The most recent bearish cycle from the year 2000. It tells us something about long-term cycles and how they affect medium-term and short-term cycles. So even if we're intraday daily traders, this is still very important information. But it also tells us something about how this impacts the economy, society, and the politics around the world. On a trading perspective, it tells us what type of strategies to apply according to different cycles. So during the bear cycles, during the red squares that you can see here on the chart, having a more active strategy is more superior, and having more of a market timing, risk management focus is also very important. During the green areas, the trending periods in the market, you can buy and hold without being too concerned, and you are likely to make money. You can get things, you can make more mistakes during the bull market phases because the momentum is so much cleaner, the trends are so much easier to trade. Okay, now I just want to focus on a medium-term, long-term cycle on gold before we wrap up on this webinar. This is a chart that I've shown several times, and I just want to kind of just reinforce that gold is in a long-term uptrend and has been since 1999, as all of you know. But at the moment, it is neutral, moving sideways on a medium perspective. And the key level is 1522, that line in the sand, swing low. If we hold above that, that is very good for gold stability. If we break beneath it over the next few weeks, and certainly in the month of July when volatility is likely to increase, then please keep in mind that if we get a sustained weekly confirmation beneath 1522, that will likely unlock further short to medium term risk in the gold market into $1,300, and I've mentioned $1,300 as the key figure, potentially lower depending on how volatility changes. This would still be a normal movement in the gold market on a historical basis, and this is what I mean by looking at your long-term history, because it allows you to understand something about the personality of that market. And the personality of gold is, although it's in a long-term uptrend and has been since 1999, during that uptrend there have been sizable drawdowns. And I've just put it there: biggest drawdown, 34% in 2008, 26% in 2006, 25% in 1999, an average of 28%. So these moves can happen. Now, one of the important points I want to make here is that during 2008, when we had the credit crisis really kind of trigger a lot of volatility in the market, and a lot of markets were turning lower, but there was a lot of political and economic stability during that time, and gold as a safe haven, as a traditional safe haven market, should have pushed much higher. And it was roughly trading around the 1,000 mark. You can see that 2008 gold was trading around the 1,000 mark. Now, it didn't break that $1,000 ceiling. It actually pushed lower by down 34%. And one of the key reasons for that is two key reasons. One, the market was very overbought, it was very leveraged, it was a very overcrowded trade. So it's just technically it needed to unwind before it could resume the uptrend. The second reason, and this is quite important from a macro perspective, people in the market, traders and investors, needed to deleverage. They needed to unwind those overcrowded trades, those trades which they had been trading for so long. And gold was one of those markets. Now, here and now, we're in a similar situation, a deja vu situation to 2008, both technically and economically. And this is why I would really keep my eye on the 1522 level, because it might unlock a historical parallel that we last saw in 2008. If you want to have any questions on this, I'm going to speed up because we're running out of time here. Borty's just asking, so Fernando is saying you're absolutely green your gold piece. Thank you very much, Fernando. And Borty's asking, do you prefer candles or bar? I prefer candles, but if I'm looking especially for intraday, daily, and weekly charts, but if I'm looking at long-term charts like the one I'm looking at now, I'll switch to bars. But I'm very much a candle pattern trader, and it's a specialization of mine. So this is the chart on gold. I will do a presentation on gold because I think gold can be very important in the coming weeks and months. And I really want to make sure that I'm giving you guys as much good advice as possible when you're watching your charts every day. The next and final chart is US GDP. Now, a lot of the time we talk about financial market cycles. So we talk about the US stock market, we talk about currencies, we talk about gold. But very rarely do people talk about economic cycles. Now, I can talk about economic cycles in a whole separate presentation because this is very important. A lot of cycle work was developed in economic analysis by a lot of very well-known cycle experts throughout history. Now, one of the very important cycles to keep in mind is the 10-year cycle, roughly 10, 11-year cycle, which tends to show up on economic growth indicators, such as US GDP, gross domestic product. And you can see here that every 10 years or so, we tend to get a recessionary period on US GDP indicators. So this is a chart which I've had for some time now, showing recessions beneath the zero line whenever US GDP is beneath zero, negative for 2 consecutive quarters. That is the official definition of recession. Now, the last time that we had a strong recession was, of course, during 2009. That was the fastest recession we've had since the 1930s, since the Great Depression, and it was one of the deepest. We had a very large contraction in US GDP in just one quarter. Now, the question mark I ask here is in 2012 or 2013, are we likely to see recessionary consequences where we then have a double dip recession, which was lasting in the 1980s. Keep in mind we had a double dip recession. It started in 1980 and then in 1982, and that was triggered by the US-Iranian oil embargo. Interesting note that 1st of July, we're also having a Europe-Iranian oil embargo. That will lead to some volatility, potentially, maybe not a recession, but that might add to the whole recessionary pressure if you keep in mind the European contagion, which is increasing as Greece potentially exits out of the euro. Most people are expecting it to happen, but not many people know how that will impact the market. Spain, the banking crisis, which is about to be triggered, which then, of course, can hit Portugal and many of the other peripheral countries and the core countries like France and eventually Germany. And then, of course, we have the US, which have their own growth issues. We have the employment numbers that came out worse than expected last month. I successfully made a market recommendation on that, suggesting that we might get worse than expected employment, and I think that will continue into the summer months ahead. So there's a variety of reasons why we might be getting a perfect storm for weaker than expected economic growth, which will have an impact on US GDP figures and various other proxies, also the financial markets, of course. And you can look at cycles on these economic cycles, on these economic indicators and financial markets. Now, just to finish up, this is the chart which I showed several webinars ago, just to show you how we are potentially positioned in Western economies and financial markets. You can see here the three cycles I spoke about: the long term, the medium term, and the short term. And certainly 2007 marks the top of the long term cycle. That probably began in the year 2000, but very much started to take fold in 2007. We really started to see that in 2007 with the Black Swan event. We had the bottom in 2009, had a peak in 2011. And so my view has long been that second quarter of this year, so the first quarter of this year was a positive short-term recovery, and the second and third quarter were likely to be the very weak period in the risk appetite, high risk appetite market, such as euro dollar, Aussie dollar, some of the resource currencies, and gold and the stock market. So I think that will continue for the second and third quarters during the spring and the summer months. Keep in mind this is part of the traditional observation of sell in May and go away. Markets tend to be quite volatile during the spring and summer period when volumes are quite low. And the buying opportunity or the low is likely to take place in the month of October onwards. But we are likely to see further volatility next month in the month of July, and then, of course, October, which is traditionally a volatile month. But the buying opportunity is likely to appear roughly there. Okay, so just quickly checking, Mike's asking, do you follow any short-term economic reports emanating from different nations? Yes, I do. I focus on my technical analysis trade setup, so I look at a lot of macro facts as well, and that includes economic indications. Just quickly checking some of the other questions. We've had quite a few questions recently. So Boki says, so the GAM saying, don't you think that the Greek election might have an immediate impact? It may do, but I think the main focus now, aside from the elections, is this whole exit risk, what will happen, or the Brexit. Thanks, Boki, for giving me good luck for focusing on the market independently at the moment. Thank you very much. And then Fernand's making a point about lower lows before high highs. Basically, if you're looking for a textbook explanation, that would be it. And also point, Spain is just beginning, agreed, and this is the contagion effect which is likely to hit the market eventually, sooner or later. And I thought you said Portugal next. Okay, so I think that's all the questions. I'm just quickly just to finish off. We've basically focused on part one, looking at a high-level focus on cycles. Why time is important. Remember, we looked at that cheetah, and I asked you the questions, how you felt, how important timing was for that cheetah in life, but also in the financial market. The history and importance of cycles. We looked at just general timings and the watch that we wear on our wrist and how important that is in our daily life. How the Mayan civilization developed their calendar with exceptional accuracy by studying the planetary movements, and how psychology in the financial market has the perfect cycle, where we have the emotional stages of hope, greed, and fear, developing that S-wave cycle. Part two, we looked at the classic methodology, just focusing on trends, key levels, and indicators, but the key focus on trends and cycles. I made the point that knowing your history is really important, especially when you're looking at markets like gold or the US stock market. Moving averages help you understand cycles. So long-term moving averages, 200-day moving average, medium-term cycles, the 50-day to 100-day moving average, and short-term, roughly 20 to 25-day moving average. So these three moving averages allow you to understand that multiple cycle influence in the market. And if you're trading intraday, I would say exponential moving averages are best because they're more responsive and more sensitive. And maybe using several moving averages, a layer of band of moving averages is probably good because that really does give you more information in the market. Part three, we just focused on cycles in the market, and I focused on the stock market, gold, and economic growth, US GDP figures, as potential examples to keep in mind. Now, ending on my positive mantra, as always, enlightenment through realized knowledge. With any questions, please feel free to email me on the email address, the new email personal address, which I highlighted to you, roniwilliam@gmail.com, roniwilliam@gmail.com, and I'm happy to as soon as possible. And just final, please tune in to the next webinar on the Thursday, the 12th of July at 3 p.m. GMT, the secret behind Fibonacci analysis. Please feel free to attend that webinar. I look forward to seeing you then. An honor and a pleasure, as always. Thank you very much. Ron Williams, technical strategist here in Switzerland.